Welcome back to our channel, where we break down the latest news affecting the Iraqi dinar. Today, we're re-diving deep into a major development. The Iraqi government has officially approved its 2025 national budget. This has sent ripples through the community, with many asking the big question: could this finally be the catalyst that sends the dinar soaring? Let's get into it. The short answer is, it's complicated. While the budget approval is a positive step toward fiscal stability, it doesn't automatically mean the dinar is about to revalue. To understand why, we need to look at what's actually inside this budget. First, it's important to know that the 2025 budget is part of a larger three-year spending plan that was approved by the Iraqi parliament, covering 2023 through 2025. According to an advisor to the Prime Minister, this plan projects a total deficit of about 64 trillion dinars. The budget is built on some key assumptions: an oil price of $70 per barrel and an export capacity of around 3.4 million barrels per day. Unsurprisingly, oil remains the absolute lifeblood of Iraq's economy. Data from the Ministry of Finance shows that in the first half of 2025, oil revenue accounted for over 90% of the government's total income. Just to give you an idea of the scale, from January to May, total revenues hit about 46 trillion dinars, and a staggering 41.9 trillion of that came directly from oil sales. Now, let's talk about where the money is going. A huge chunk is allocated to current spending, mainly government salaries and social welfare programs. The Ministry of Finance reported that employee salaries amounted to nearly 28 trillion dinars, with another 8 trillion going toward pension payments. This heavy focus on current spending comes at a cost. Investment in the country's future, particularly in infrastructure, has taken a significant hit. Reports from mid-2025 indicate that capital expenditures, which are crucial for long-term growth, have dropped by about 33%. This is a risky trend, as it signals underinvestment in the very projects that could help diversify the economy away from oil. Despite these concerns about deficits and spending priorities, the first half of 2025 delivered a surprising twist. According to official government data, Iraq actually recorded a fiscal surplus of $4.5 billion. During this period, total revenues were around 62 trillion dinars, while expenditures were about 56.6 trillion. On the surface, this sounds like fantastic news, right? A surplus is always better than a deficit. But when we scratch beneath the surface, we find some worrying fragilities. First, even with that surplus, the Ministry of Finance also noted that total revenues actually fell by about 6% compared to the same period in 2024. This suggests the surplus might be more about controlled spending than booming income. Second, the extreme dependence on oil is a massive vulnerability. With oil making up 91% of revenue in some months, any significant drop in global oil prices could completely derail the budget's projections. This isn't just a hypothetical risk. According to the Economic Observatory Eco-Iraq, the country is currently selling its oil at around $68 per barrel. That's below the $70 per barrel assumed in the budget, meaning the fiscal targets are already under threat. Third, the weakness in non-oil revenue is alarming. Reports show a sharp 14% drop in certain non-oil revenue categories during the first half of the year. This decline makes the economy even more exposed to the volatility of the oil market. And finally, there's the issue of the break-even price. The International Monetary Fund, or IMF, has analyzed Iraq's finances and determined that due to growing expenditures and other structural issues, the country now needs oil to be priced at around $94 per barrel just to balance its budget. 2. With oil currently trading well below that level, maintaining fiscal stability will be a major challenge. So, with all this context, what does the 2025 budget approval really mean for the Iraqi dinar? Will it trigger a revaluation? Let's break down the key dynamics. First, the budget does provide a fiscal roadmap. It offers short-term stability and reassures markets that government spending is, at least on paper, under some control. The surplus in the first half of the year is an encouraging sign, showing that under the right conditions, Iraq can bring in more than it spends. However, this is not the whole story. The shrinking non-oil revenue and the ever-present volatility of oil prices mean that we can't guarantee these surpluses will continue. Without strong, diversified earnings from things like taxes and other industries. Iraq's long-term financial health remains fragile. This underlying weakness seriously undermines any argument for a significant and sustained revaluation of the dinar. A one-time surplus just isn't enough. Second, we have to consider the risk of monetary financing. This is a huge threat to the dinar's value. If oil prices were to drop sharply, Iraq could be forced to cover its deficit by simply printing more money. The IMF has specifically warned about this, stating that without major policy adjustments, fiscal deficits could push the government toward this option. Printing money to cover debts is a classic recipe for inflation and currency devaluation, and it's one of the biggest dangers standing in the way of a stronger dinar. Third, there are political and external risks to consider. The 2025 budget isn't immune to political gridlock. Some reports suggest that due to anticipated delays in forming a new government, Iraq might not even pass a budget for 2026. If that happens, the government would have to operate under a restrictive 1/12 spending rule, where it can only spend 1/12 of the previous year's budget each month. This kind of uncertainty would likely scare off investors and create instability in the currency markets. Furthermore, ongoing disputes between the central government in Baghdad and the Kurdistan region over oil and revenue sharing remain a major wildcard for the country's long-term fiscal stability. Fourth, let's talk about investor sentiment and speculation. Many currency speculators were hoping the 2025 budget approval would be the magic bullet, the event that finally triggers a revaluation, or RV, but a real revaluation requires much more than just a positive headline. It needs sustained fiscal discipline, a genuine diversification of revenue sources away from oil, and deep macroeconomic reforms. While the budget is a step in the right direction, most serious analysts remain cautious. The structural risks are very real, and a single surplus, as we've seen, is not enough to guarantee a major rally in the dinar's value. So, what's the bottom line? Is the dinar about to surge? The approval of the 2025 budget is a positive development that provides a short-term framework for stability. It might instill a bit of confidence in the markets. However, it is highly unlikely that the dinar will skyrocket simply because this budget was passed. A real, sustained increase in the dinar's value would require fundamental changes, deep structural reforms, a significant increase in non-oil revenues, and consistently high oil prices. The looming risk of the government printing money to cover deficits, combined with political uncertainty, makes a large-scale, permanent revaluation a very risky bet at this point. That said, it's not all doom and gloom. If Iraq can manage to consistently deliver surpluses, reduce its dependency on volatile oil markets, and implement the necessary reforms, there could be room for a gradual strengthening of the currency over the long term. This budget is a small piece of a very large and complex puzzle. It's a potential shot at stability, but it's certainly not a guaranteed win for the dinar. What do you think? Is this budget the turning point, or are the underlying risks too great? Let me know your thoughts in the comments below. Thanks for watching, and if you found this analysis helpful, please be sure to like, subscribe, and hit that notification bell so you don't miss our next update. See you next time.